Oh, welcome back to the channel, guys. I'm your host, Buckning, and today we're going to talk about how easy the stock market is. Controversial? Maybe. Myth? No. Truth? Yes. But we're going to talk about it and why the stock market is easy and not as hard as some people may think. I think that's an internal thing for a lot of people. I think it might just be a mindset, but we'll get into that. But if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. If you're not new, welcome back. So as we always do, we'll give you guys an update on the portfolio here, show you everything that's in there, what it's starting off at the beginning of the week, and yeah, we'll just go from there. So today, the portfolio itself closed out at $12,111.07, down $3.09, down 0.03% for the 1 week. We are up $80.35, up 0.67% for the 1 month, down $832 and a penny, down 6.43% for 3 months. Oh man, we are down $1,335.31, down 9.93% for the 1 year. We're down $107.75, down 0.88%. And for the all, since starting this portfolio, we're up $830.12, up 7.36%. A lot of the positions were down today. Qualcomm popped off today a little bit there at a 3.48% return today, or uptick there. We got $112.88 in the cash count with $100 currently unavailable. And we're getting right close to the end of the month here, so we can do our dividend tracker and show you guys how much we received for the month of June 2022. And so, yeah, that's the portfolio there. Market is still doing what it's doing. But let's talk about why the stock market is pretty easy and why I think a lot of times it's just a mindset thing that happens when we're going through times of market downturn, and how we're feeling. Because for a lot of people, they are feeling it. We get that. But the stock market is easy. We're talking about specifically the S&P 500. And now, I think it's pretty easy because as long as you have a goal in mind where you can step back and look at why are you putting money in the marketplace, why you're doing what you're doing, why you're allocating funds there, and you have it for a long period of time. And I'm not talking about thinking that if you invest in the S&P 500 or the NASDAQ or the Dow Jones Industrial Average or even the TSX, that you are going to be super filthy rich tomorrow. That's just not realistic. So if you are doing that, please understand that every single day, if you're trading these indices, like I mentioned, the S&P 500, NASDAQ, and so on and so forth, you have a 50% chance that you will make a return or you will lose value in that trade. And so it's just not recommended. If you're doing these types of indices that have a broad market where it's very diversified, where you have 500 companies in it, or the top 60 in Canada, or the NASDAQ, which is strictly allocated to tech, and the Dow Jones, these are indices you want to hold for the long term. And I'm talking like retirement. I'm talking like 10, 20, 30 years, something that will fund your retirement. If you're trading on these on a daily basis or on a weekly basis, or you've sold them or anything like that, and you're in a younger demographic, I don't think that's the right move to make, because it's always proven that the longer you hold indices, not like weird ones, but like, general, the ones that everyone talks about on the news, S&P 500, NASDAQ, and so on and so forth. Those are the ones I'm strictly talking about. You are almost guaranteed that you will make a return that will fund your retirement. And if you're doing it thinking that you're going to get 100% return, or 10x return on an S&P 500, NASDAQ, or so on and so forth, I think that is very unrealistic unless you're holding it for the long term. And even that can sometimes be, very hopeful, very, what's the word? Optimistic. But as we can look here on a 5-year on the Vanguard S&P 500, you're looking at a 55% return. So you're pretty much doubling your money up at that point. I wish I could go max, but I can't. But you can see over 5 years, it's only 55%. Now, let's talk about the S&P 500 specifically. A lot of people think that it's just this index that you just invest in and never pay attention to, which is fine, which is the reality for a lot of people. The thing is, did you know the S&P 500 has earnings? They do quarterly earnings as well. And if you don't know that, then, and it's never ever talked about, it's something that people don't talk about because it's just kind of a set it and forget it kind of thing. And we have to pay attention to that. Now, the S&P 500 is the most common that everyone talks about, 10% every single year on average over a long period of time. We're talking 10, 20 years, 30 years, maybe 40 years, maybe even 50. Okay. Now, the S&P 500, now we all know this. We all know it's made up of 500 different companies on average, the top 500 in the US. Now, we don't know why, but a lot of people in today's market sentiment, a lot of people have fear in the marketplace, which could cause a lot of downturn in the market due to uncertainties that are happening, things that are happening on the other side of the world, inflation, interest rates rising, and so on and so forth. These things are not everyday occurrences, but I beg to differ because we are always uncertain of what's going to happen the next day in our lives, in the stock market, absolutely anywhere. We live with uncertainty. However, sometimes it's pushed a bit too far where the market starts doing this thing that it's doing right now. Now, I'm not an economist. I don't want to pretend to be. I'm just not that. I'm just a regular guy on YouTube, but hear me out when I say this. We should be cheering on the fact that everything is at a cheaper price as long as you're holding on for a long period of time. I'm not even going to say 5 years because I don't even think 5 years is long. I'm talking 15, 20, 25, 30, 35 years holding on to those positions. And we should be cheering the fact that everything is going down in stock price because everybody knows price, whether it's in the stock market, whether it's not in the stock market, everyone looks at price. Okay. When that is the kind of thing that is almost universally understandable, I think this is where we have to understand that sometimes there are companies that are a absolute steal of a deal when they're down in stock price, and some that are riskier at a lower stock price. Because you have to remember there are companies that grow and there's companies that don't grow, but there's companies that pay back capital, return your capital, and some that raise capital. When we talk about raise capital, you're talking about a company that is fairly new, that is still in the growing phases and continue to raise capital. Now, if the stock price is low, they are not able to raise as much capital for the company growth as if the stock price was higher, like maybe 3 times higher. They would get 3 times the money if the stock price was 3 times higher to invest in capital expenditures, expansion, and so on and so forth. But then you have more established companies that are capital returners. I'm going to make that word up. These are companies that will return capital regardless of how the market is. They have huge tons of amounts of cash that they can use to get through times like this, to continue to pay out investors, to continue to make sure that their company keeps on running. And when these companies, these more established companies that maybe pay out a dividend, that maybe do share buybacks, we talk about that. I quite enjoy share buybacks, but think about it. If a company's stock is $100 and they're buying shares back at $100, they're taking those off the market, they're paying $100 regardless, right? And returning capital to investors. But let's say the stock price is $50. They're getting their stock price at half the price and buying them back at a cheaper price, which is adding value to the investors' earnings per share or earnings on that share. and they are returning capital at the same time. So it only makes sense that as investors or as people who are looking at the stock market, the more established, matured companies we want to look into to buy at a cheaper price, just like the company itself is doing to buy back shares to increase value. And of course, we're all in it for ourselves. We're all in for ourselves. I'm not buying stocks for the sake of somebody else. I'm buying it for myself to make sure I have a good life in the future, to invest and capital that I know will be used later down the road. There are savers and there are not savers. There's investors, I guess, but you want to save to invest, or just invest to make sure that you have something in the future, because a lot of people will not have that. But then the argument comes up, but we don't have enough money. Well, you got to check your balance sheet. You got to check your own life's balance sheet to make sure everything is in place. Maybe no debt, maybe 6 months savings, other streams of income, and so on and so forth. I don't want to sound like those ads on YouTube where you have to create another stream of income. I'm not that, and I'm not selling a course. And so just make sure that you are investing for the right reasons and not gambling. Because if you're investing in the S&P 500 or any kind of indices or any kind of individual stock and you're hoping to get rich tomorrow, that is called gambling. That is not investing. And that's why you are hurting yourself and you're hurting your future, essentially. But none of this is financial advice. That's my 2 cents on why the stock market is easy, because it actually is. If you're investing in the stock market in good quality companies and holding them for 15, 20, 30 years out, whatever time horizon you're holding out, and not just 1 day, 1 week, 1 month, a year, the overall return over that time period is probably almost 100%. Now I'm pulling that number out of my you know what, but I'm pretty sure your odds are much better than 50-50. Your odds of having wealth built in the future is much, much better. So other than that, guys, hopefully you did enjoy the video. Don't forget to leave a like and subscribe. As you can see, a suitcase is in the back because I'm going to be gone for the month of July, but I'll continue pushing out those videos for you guys. And so have a great week. We'll see you in the next one when we talk about the dividends for the month of July, or not July, June 2022. And yeah, we'll see you in the next one. Bye.